During the past 2 weeks, we have explored the relationship between inputs and output in the short run and also in the long run. This week, we will be studying the behavior of firms in perfectly competitive markets. So there are 4 objectives. The first is to explain the responses of competitive markets in the short run and long run, and how shifts in demand and cost affect these markets. Secondly, we will explore the role of profits in competitive markets. In free market economies, firms respond to changes in profits, whereas in command economies like China, firms may not respond to profit changes. Many of their firms are state-owned enterprises, and sometimes, despite their huge losses, they may continue to exist depending on the policies of the decision makers in China. But in free market economies, firms respond to changes in profits, economic profits. Third, we will consider production decision shutdown rules in response to changes in prices. Depending on whether price exceeds minimum average variable cost or not, firms may shut down their production plants or continue to produce and sustain some losses, economic losses. And finally, we will compare allocative and technical efficiencies as they are related to perfectly competitive markets. So there are several types of markets. It seems like there is competition everywhere, more fierce in one market than others. And here are 2 pictures of sandwich shops, and entry in this kind of business does not require a huge amount of capital investment. Maybe a few $1,000s to pay rent. That may be the fixed cost, and that's not a heavy requirement. In other industries, entry requires a huge capital investment. For instance, for offshore oil business, oil drilling business, you need an ocean oil drilling rig, which costs maybe $650 million. And that's not a small amount of money. Likewise, in airline industries like TWA, Northwest Airlines, United Air, etc., they require huge investment because they need to maintain several fleets of airplanes. And spending a huge amount of money on capital equipment does not guarantee that their businesses would be profitable. In 1666, or the so-called miracle year, Isaac Newton conducted the prism experiment. In a dark chamber, he punctured the hole and let the sunlight in, and also through a triangular prism. And lo and behold, he saw a spectrum of 7 colors. Likewise, when economists use a magnifying glass and take a look at the market structure of free market economies, they see a wide spectrum of firms, ranging from competitive firms to monopolies. So they look at these parameters. How many firms are there in the market? Are they producing homogeneous products or differentiated products? For instance, corn and soybeans are homogeneous products. When we consume corn, we cannot tell in a blindfold test whether those corn is produced in Iowa or Missouri or Illinois. But when consuming pizza, more often than not, connoisseurs can tell what kind of pizza it is, which producer is producing those pizzas, and so on. And also, in terms of market power, can a single firm influence the market price or not? And finally, barriers to entry. How big is the entry barrier? Can everybody enter the market and compete with the incumbent firms or not? So when we are using a magnifying glass and look at the various forms of businesses, we can generate this table. So in terms of the number of firms, there could be, in a perfectly competitive market, we have a bunch of firms, large number of firms producing identical products, and none of these firms have influence on the market price. And there are no entry barriers, practically speaking. When we go to the other end of the spectrum, we have monopoly, meaning in Greek, one seller. So there is only one seller in a monopolistic market, and there are no competitors, so there is no need to differentiate their product. So product differentiation is out of question. Do monopolies have market power? Yes, and they try to influence, they try to fix the price. Are there barriers to entry into this market? Yes, because there is only one firm in the market, they must have significant entry barriers. Between perfect competition and monopoly, we have still other forms of organization. One is called monopolistic competition. There are many firms, each of them producing differentiated products. They have some influence on the market price because each firm is setting its own price. Are there entry barriers? No. Entry barriers are practically zero, and that explains the large number of firms in such a market. And also we have oligopoly. There are only a few firms producing either identical or differentiated products. And they have some influence on the market price, but before they raise prices, they have to watch whether other firms will follow suit or not. So you have to keep an eye constantly on the pricing behavior of their rivals. Are there entry barriers in oligopolistic market? There are some, and that explains why there are only a few firms in such a market. So let's begin with a perfectly competitive firm. These competitive firms do not have monopoly power. Prices are determined by the market force, and competitive firms can only adjust the quantities of their output. So examples are farmers producing rice, wheat, or corn. These are examples of perfectly competitive firms producing homogeneous products. So how are the market price determined? Well, by the intersection of demand and the supply curve, and the intersection of this yields market clearing price of say $25, and that determines the price in that market, and that price line, horizontal price line, is the individual firm's demand curve. It's horizontal, not negatively sloped. If a competitive firm doubles the output, it does not affect the market price. So how does a competitive firm choose its output level? Well, as long as price is greater than marginal cost, the firm should keep increasing the output as long as price exceeds marginal cost. But once price equals marginal cost, you have to stop there, hold your horses. No more output beyond this level of output, okay? That's how a competitive firm chooses its equilibrium output. Next, what is marginal revenue? In a competitive firm, revenue is price times output. Okay. So what is marginal revenue? That would be change in revenue divided by change in output. Now, price in a competitive market is fixed, it's given. So change in revenue is simply price times change in output. So these two cancel each other, and marginal revenue is simply price. And price does not change, it's fixed. Next, take a look at the production decisions. If price is above average cost, there is nothing to worry about. Price, the firm must keep producing the output. The level of output would be where price equals marginal cost. But since price exceeds average cost, profit is positive. No problem there. The problem occurs when profit is negative. This is because price is less than average cost. Now you have to make a decision, to be or not to be. Should the firm sustain the loss and continue producing this output or not? Well, the answer is it depends. Remember, fixed cost is fixed. It does not affect production decisions. Your revenue is price times Q, price times Q. And the criterion is whether your variable cost, which is equal to wage bill, wage rate times the amount of labor. This is the amount of money that you have to pay to employees. If revenue exceeds your labor cost, then even though you may be incurring a loss, that loss is still less than the amount of fixed costs. So in this case, keep producing. But if price ever falls below, if price level ever falls below the minimum of average variable cost, the firm needs to shut down the factory and give notice to all the employees that they are not required at the factory. This way you can cut your losses. You can minimize your losses equal to the amount of fixed cost. So here are the three cost curves. All three curves, marginal cost, average total cost, average variable cost, all of them are U-shaped. And notice marginal cost is going through, marginal cost curve is going through the minimum point of AVC, the minimum, also the minimum point of the average total cost. Okay? But all these three cost curves are U-shaped. So how does a firm choose its supply? Well, if price is higher than average cost, you are making money, there is nothing to worry about. So price equal marginal cost right there, that's the optimal output. Price fall, if price falls to P4, no problem. Price is still higher than average cost. So you should produce the rate of output where price equals marginal cost. A question arises when the price falls below the minimum of average total cost. That means below this, the firm is not making money, but is incurring a loss. Pi is less than 0. If price is above the minimum of average variable cost, price loss will be less than fixed cost. So you should keep producing the output. If price ever falls below the minimum of average variable cost, that's when the firm should shut down the factory, and Q would be equal to 0. Call all the laborers and tell them they're not needed at the factory next Monday. So here are two questions. Which of the following is true? Competitive firms always make a profit? Not necessarily. Firms sometimes continue to operate even if they are experiencing losses. Yes, but if price is below minimum of the average variable cost, then shut down the factory. Don't produce anymore. Optimal output in the short run is 0. Next, which of the following would most likely be considered a market with free entry? International shipping. These containers cost huge amount of money, so that's not entry in that industry. Shipping industry is not easy. Selling homemade crafts. This does not require a lot of money, maybe a few $100s. Sewing machines and things like that. Gold and silver mining, again, that requires a large amount of money to purchase bulldozers and tractors and whatnot. So that's going to cost a lot of money. Commercial real estate, that also requires huge amount of money, millions of dollars to buy and maintain the real estate properties.